Hello everyone, I'm Sebastian Y and this is Foundations of Economics. Over the next two videos, I'm going to talk about the monetary system and the banking system. In this video, I'm going to talk about the role of money in an economy. The first question that we need to answer here is, what is money? In casual conversation, we often conflate the concept of wealth with the concept of money. For example, you might say that someone has a lot of money, when what we really mean is they have a lot of wealth. In macroeconomics, money has the specific definition as the set of assets in an economy that people regularly use to buy goods and services from other people. Money fulfills three main functions within an economy. Money is a medium of exchange, a unit of account, and a store of value. As a medium of exchange, money functions as a device for facilitating transactions. If there were no money in an economy, then we would have to rely on barter, trading one good for another. The difficulty we run into with barter is that it relies on both parties in the trade having something that the other wants, and that's not always going to be the case. Money allows one person to buy one good from another, and then that person can use that money to get what they want from someone else. This makes it much easier for people within an economy to specialize in the good or service in which they have the comparative advantage. The second purpose of money is as a unit of account. Money gives us a convenient way to measure the economic value of goods and services and compare them with each other. In the United States, we use the US dollar to easily compare the value of different things. If we did not have money, we would be forced to think about the value of a certain good in terms of another good. The third and final purpose for money that we're going to talk about is as a store of value. Money is a way to hold wealth and use it later. That's not to say that other things can't be used as stores of value. For example, holding stocks, bonds, or real estate can be a way to do that. But you can't go to a store and buy things with your stocks and bonds. We have to convert those things into a medium of exchange, that is, dollars, first. Liquidity refers to how easy it is to convert a store of value into a medium of exchange. Stocks and bonds are relatively liquid because it's fairly easy to sell them on the stock and bond market. Real estate is less liquid than that, certainly. But since money is also a medium of exchange, it is the most liquid store of value available. Other stores of value must be sold and converted into money first before they can be used to buy other things. There are broadly two types of money that have been used throughout history. Commodity money has an intrinsic value that would be present even if the good used as money was not money. Cigarettes were a classic example of commodity money. In German prisoner of war camps in World War II, Allied prisoners created their own economy within the camps using cigarettes as money. Cigarettes have an intrinsic value because even if you don't use them as money, you can always smoke the cigarette. The other type of money is fiat money. Fiat money does not have an intrinsic value, and instead it is established as money by order of a government. Most currencies used in the world are fiat money, including the US dollar. There's very little that you can do with a dollar bill other than use it as money. This is also a good time to mention cryptocurrencies, which are a new type of money that have come to prominence in the last 10 years or so. Among those, Bitcoin was one of the earliest and is also the most famous. Cryptocurrency is neither commodity money nor fiat money. Bitcoins have no intrinsic value, but also they aren't backed by any government. The value of Bitcoins and other cryptocurrencies as money remains somewhat questionable to economists. They are not a very effective medium of exchange because most retailers do not accept cryptocurrencies. Historically, they've also had a very volatile value. A volatile currency makes a very poor unit of account, and it's also a very risky store of value. The future of cryptocurrency remains to be seen at this point, but for now they are not included in any definition of money that we will use. The last thing I want to talk about in this video is the money stock. The money stock is the quantity of money circulating in the economy. In order to measure the money stock, we need to be specific about what exactly we define as money. This is not as straightforward as it initially seems. The most obvious part of the money stock is currency. In the US, Currency includes all the various denominations of dollar bills and coins. This, however, is not the only part of the money stock. Currency is not the only part of the money stock because there are other kinds of money out there that can be used for all three functions of money. We categorize all these types of money by their liquidity. Currency is the most liquid form of money, but there are some assets that are nearly as liquid as currency. Most retailers will readily accept checks or debit cards which pull funds directly from a customer's checking account. And so we generally think of checking accounts as highly liquid assets. Traveler's checks are also highly liquid, although they are relatively rare today. These are the three main components of what we call M1, the first of the two monetary aggregates that we use to measure the amount of money circulating. M1 consists of the most liquid types of money. We can expand our definition of money to include some other slightly less liquid assets. These include savings accounts. These typically have higher interest rates than checking accounts, but in exchange have limitations on how many withdrawals can be made. This makes them a bit less liquid than checking accounts. There's also time accounts. These are often also called certificates of deposit. These are accounts that also have a higher interest rate than checking accounts, but funds cannot be withdrawn from time accounts until a certain amount of time has passed. This again makes them less liquid. And finally, there are money market mutual funds. Recall that mutual funds allow a person to save money by distributing those savings across a portfolio of assets. Money market mutual funds specifically have a portfolio of short-term government debt like treasury bills. The second monetary aggregate, M2, includes everything within M1 plus these other less liquid types of assets. If we look at a graph of M1 and M2 over time, we can see that M2 is always bigger than M1 because it includes everything within M1. We can also see that both monetary aggregates are growing over time. We can see that the growth of the money stock has increased particularly quickly in this year, 2020. Now that we've established the basics of what money is, in the next video we are going to talk about the banking system and how that interacts with the money supply.